Welcome back, ladies and gentlemen. I have the privilege to be joined by Lior Gantz, a guy that I've worked with over the years now. It has been quite some time, multi-million-dollar investor. The guy is the CEO of wealthresearchgroup.com. And we're going to be talking broader about the markets. We're going to be talking about the pandemic, hyperinflation. We're going to be diving down into some individual stock picks and how he thinks this year is going to pan out. This should be a very fun, broad conversation. And if this is something you appreciate, just consider hitting that like button, subscribing for those future updates. But to kick it off, welcome, Lior. Pleasure to have you.
Thanks for having me.
Yeah, man. So let's just get right into this. I know we've been talking pretty aggressively about the pandemic. It's been a hot topic, and we're going to come around to that. But I just really quickly want to touch base on your thoughts surrounding the current kind of hyperinflated market. We had Elon Musk just come out and kind of mention that, you know, he's expecting, and again, these are kind of like macroeconomic speculations, but what are your thoughts on just kind of a recession coming, considering stocks have been very volatile to start the year? People are kind of intrigued by these logistics shortages that are still going on. I've got a few thoughts on it, but what are you thinking? How do you think that's going to pan out here?
I think in terms of a recession, which means a contraction in GDP,
yeah.
For 2 quarters in a row, I don't see it happening in 2022. It doesn't look like that's where the economic machine is going towards. And I did read Elon Musk's thesis, and he said, I don't know. That's what he said. I don't know. And it could be in 2023. So look, recessions happen in the United States between 1776 and today. They happen on average every 6 to 8 years. So they happen all the time. And they're not a bad economic event if you're prepared for it and if you capitalize on it, because on the flip side of the recession, there's obviously a boom. So that's key to remember. If you're prepared for it, if you know how to build your life, your career, your portfolio to cater for it, then it's an opportunity. If you think about it this way, I think if you look at 2022 in terms of the negative catalysts, you've got the midterms, which are a big negative catalyst, because you got a trifecta with the Democrats controlling the House, Senate, and the presidency. And when that happens, historically, when it's a blue trifecta and it's a midterm year, especially with the Build Back Better plan not going through, there's many things that are up in the air. Are you going to have higher corporate taxes? Are you going to have corporate taxes? Higher taxes on the wealthy, on the billionaires? What's going to happen with cannabis legalization? What's going to happen with infrastructure, stimulus checks, UBI, all of these things that were inside of the social infrastructure bill for Build Back Better, and they're now up in the air. What's going to happen with them? What are going to be the campaign promises as we go into the midterms? So that's one big negative catalyst that is creating a lot of uncertainty. But that's not the big one. The big one that is going to really play out is what the Fed is going to do with interest rates. So, and we can talk about that later on in the show. I assume you have some questions about that, because that's basically what's happening in the last 3 days in the market since we started the year. Monday, Tuesday, and Wednesday have been all about the rise in interest rate. I think the third thing that is more of the reasons that we can have a slowdown or a mini recession or even a recession. I think if you look at what really can hurt the US economy, it would be the jobs market. The jobs market right now is very, very tight. The Fed speculated and the government speculated that once they lower stimulus checks and eliminate them completely, and once the stock market stops being so hot, that more people will come back into the workforce, and that's not happening. A lot of people have retired half of the family unit, so perhaps if the husband and wife were both working, now only one of them is working because real estate prices have gone up, rents have gone up. They've been able to passively make up for the salaries of 2 individuals now being one. You're seeing a lot of people that are still scared, or that they have children and they don't have an arrangement for school days where you have to be in isolation and stuff like that. And you're also seeing a lot of people that have opened new businesses. There are 600,000 new businesses in the United States alone. That's a record that shatters all previous records. So a lot of people came back home. Now they're working from home. They have their own little business going on, and that's their new lives. Many others have went back to school and they're out of the workforce for 3-4 years, and they're in their mid 40s, early 50s. So I think the jobs market is where this key to whether or not we have a slowdown or not. If corporations are going to have trouble raising, getting employees in, and they'll need to raise wages further, that hurts profitability, that hurts companies' bottom line, and that will obviously impact economic growth in the United States. This is a demand economy. The United States, every person has a car on average. Every person has a phone on average. Every person has a house. So we have everything. It's a demand economy. It's about how much people want to have more and more and more and more. You need consumers to spend. That's 72% of GDP. And so I think that because of these supply chains last year, a lot of companies, Walmart, Target, all the big ones, Costco, etc., they've hoarded so many more items than they've actually sold, and they've warehoused them, that they'll need to get rid of this year. And you'll see a lot of discounts in 2022, a lot of liquidation sales, big sales, special Fridays, special Mondays, whatever you want to call it. And the consumer will have a lot of chances to buy cheap. And if you see the consumers acknowledging that and going shopping for appliances, for homes, for home furnishings, for everything, for the garden and everything else, then you're going to have a strong economy. If you see them shying away from large discounts, then yeah, we have a problem.
Yeah, see, that's an interesting point, because I try and look at two sides of this coin, and you hit on some things that I want to talk about with the supply constraints, because the only reason that I could see a recession coming up is for that primary reason that you mentioned, because for most people that don't know what a recession is, it's 2 quarters of negative GDP growth, which can be driven from the fact that you just said, a lot of people have been stockpiling goods, and I deal with a lot of pharmaceutical companies, a lot of companies in different sectors, and they're piling up 8 months worth of supply and warehousing. This is why we're seeing warehousing doing so excessively well for companies like Amazon, Stag Industrial, a lot of the industrial REITs. But like you're saying, the problem is if we get to the other side of this logistics problems, now we have all these big manufacturers that can't ship these products to these guys that have 8 months worth of supply, and then we start seeing price reduction, which can lead to that negative inflation rather than hyperinflation, which can technically lead to somewhat of a recession. But on the other side of that note, the funny thing too is the demand is so absurd right now that when you're looking at some of these top 10 companies like Apple, which on the last earnings, I think Tim Apple, I like to call him, is what the Trump joke was or whatever.
Tim Cook.
Yeah, Tim Cook, but I'll call him Tim Apple. But it's just funny because he mentioned that I think they lost $6 billion to these logistics problems in the last quarter. And when you look at like NVIDIA and just the demand for these products, like even if you start seeing a price reduction, like you're saying, the demand is so insane that if they can just get rid of the logistics problem, we could still see like record sales, record numbers coming out of these companies this year. So it's kind of like a double-edged sword where it's kind of hard to predict exactly where the economy is going to go this year, which is making it rather fascinating for me anyways. But on the other side of that note, then, do you want to briefly discuss, because like you said, interest rates too are going to largely affect this, but I think right now what's on investors' minds, because it's what we were talking about coming into this interview, is what are your thoughts on the current pandemic situation? Because in Canada, it's like hospitalizations aren't nearly as bad, luckily, but things are just, it's basically going to push to herd immunity at this point. Every economy is kind of taking this a little bit differently. You got any insights on that you'd love to offer?
Yeah, I think the healthcare crisis is 90% behind us. By the summer, I don't think that it will be an issue in terms of certainly no CEO on Wall Street is going to be troubled or worried about the healthcare situation. And then next winter, I think the world is so prepared for whatever comes. Usually, if you look at history, these types of situations where there's a spread around the world or just nationally, they usually end with a very infectious and non-violent strain, which is what this one is. This is usually the less raw. This is not a medical interview here, but if you look at history, and I've studied these before, if you have a very infectious, a very fast-spreading strain that doesn't do much, it's because the virus is basically fighting for his life. It's fighting for survival, and it's clearing out all the much more violent strains from the past, and it's just trying to cling on. And this is the best way to achieve herd immunity and to move on and basically treat this from next year as the same way as we treat the flu. So I think that's where the world is going. In terms of these logistics problems, the supply side is fine. Manufacturing is strong around the world. Demand side is very strong as well. The problem in 2021 was literally, how does this supply and this demand, how do you move them? Not enough ships, not enough ports, not enough shifts, and not enough trucking companies, literally not enough truck drivers. So the logistics of supply and demand were bad. I think that is going to be a problem this year as well. So I do think higher inflation than we've been accustomed to in the past decade. I do think that there are going to be, when you log on to your Amazon, you'll see insane shipping rates and delayed times for international stuff. And that's going to be probably another year and a half, 2 years of that. But we have to remember for 2 months we've shut everything down. March and April 2020. That is unheard of. It literally is unheard of. So it takes time for this to come back up. But demographically speaking, and just big picture speaking, the millennials are now 35% of the workforce. They're going to be 75% of the workforce by the time this decade ends. That means that they're going to make a lot more money than they have been. They're going to get into better jobs. They're going to get married. They're going to buy houses. They're going to invest in the markets. If I can equate our times to previous times, I would say we're like 1991, 1992. We're before big innovation booms. You have more 30-year-olds right now, which 30-year-olds is the innovation decade for entrepreneurs than ever before. So I think the markets are going way higher this decade. Real estate is going to go a lot higher. You're going to see PE ratios that we haven't seen before. And all of that is because government bonds are just going to stay very, very, very low. Negative, zero, whatever they remain at, they remain unattractive for the average person to invest in. The institutions and the governments that buy Japanese debt are basically large multi-billion-dollar sovereign wealth or pension funds that are buying the Japanese debt on one hand and shorting the yen on the other hand. They're playing a forex game. And the reason that they do that is because they are barred from owning stocks. If they were owning stocks, then interest rates would be way higher. There would be no demand for these bonds. But because of mandates, literally because of mandates that require these sorts of institutions, the insurance companies, etc., to buy government bonds, those will stay at these levels around the globe. So I think we have a great decade ahead of us, and 2022 is going to be very bumpy. In terms of the healthcare crisis, I think in 1 to 2 years, nothing will remain of this era in terms of the negative parts. All the efficiencies and everything we've learned, that's a lot of it is going to stay with us. Office space, office occupancy, I think that's changing. Companies do love their office, but they probably will not do it the way they did, where all the employees come every morning and go back. It will be some sort of, a lot of companies are adapting to some sort of a hybrid, some sort of 80% come to the office, 20% don't, etc. A lot of things are going to change. with regards to efficiencies, because we've learned a lot of things. This healthcare crisis has basically forced us to test things that entrepreneurs would never in a million years try to test. Like, how would my business operate if everyone is at home? Nobody would ever volunteer for that test, but we all did it, and now it's about the evolutions that come from it. So overall, we went through our World War II type event, and now we're in the growth coming out of it. And demographically, it's looking really well in the United States. Not so much for Europe, Japan, or China, but in the United States, it looks amazing for the next decade.
That's a great point, actually, because a lot of people always point out the fact when we're talking about hyperinflation that a lot of it's going to come from these raising wages of millennials and things of that nature. But at the same point, like you're saying, that these businesses are finding more efficiencies, which people don't talk about, like you're saying, working from home, kind of using kind of this new metaverse kind of idea of things. So it's just like, it's bad on one side, but then on the other side where they're saving capital to afford to pay those. I don't know. It's kind of an interesting conversation to be had for sure. And obviously, I think too, like you're saying, that if hyperinflation persists, that only bodes well for the markets. And I think in Canada, where I live especially, I don't think the real estate market's going to pull back that much, just because, a lot of people aren't actually selling their homes right now. What they're doing is they're leveraging them to buy second properties. Like, we're starting to see these new trends because people have made so much wealth in these markets. Rather than offload them for cash, they're basically just leveraging them into more assets, which also is going to lead to another interesting year, I think. But on that note, man, what are you thinking for stocks? I know Wealth Research Group.com, you said /2022 has a pretty good breakdown of your thesis and some predictions and companies that you're interested in. But can you give us a little bit of insights here on what companies are interesting you the most? Maybe we'll each throw out a couple stock picks here for the year that we're finding to be intriguing.
Absolutely. And we created this full economic outlook for 2022. If you want to download it for free, you can go to wealthresearchgroup.com /2022. My portfolio is actually also available for download right now in real time at wealthresearchgroup.com /portfolio. And my new limit orders for things that I'm looking at is at wealthresearchgroup.com /price. You just need to browse there and download those. So with regards to stocks that I really am looking at and think that they can do really well in 2022, I would say the one thing that I don't think will do well, so let's eliminate a lot of the things that I don't think will do well. Cybersecurity companies, the great ones, I think they will have a lot of discounts this year, and you can see great entry points if you're patient. And those are companies that I've been wanting to purchase for a long time, companies like CrowdStrike and Cloudflare, for example, and they've been so richly valued that I just couldn't. Now they're about 10 to 15% from where I want to purchase them. But I would say the downtrend, until we know what the Fed will do, until we know if it raises rates in March or in June and how many times it's going to raise rates, these companies that are high growth and their multiples are based on inflation rates in the future, I think those will do poorly. I think the top 10, as you mentioned, the FANGs, they're not only the FANGs anymore, they're the FANGs and 5 more companies, 10 companies that basically are the 35% of the S&P 500, which means that basically when you own the S&P 500, it's almost like buying a hedge fund. It's a very concentrated index. But anyways, those top 10, I think they will show a lot of resiliency this year, and I don't think they will go up by much, but they will not go down. They will not go down by much. They will show a lot of resiliency while they grow, so that going into 2023, they will be cheap. From all of those, I would say the most attractive to me seem like Facebook and Google from those top 10 companies. So if you're looking for the big 10, just for a second, I'm going to say Facebook around the $300 mark, and Google on any type of weakness, any type of 5% or 10% top to bottom move, I would be nibbling at those. In terms of big opportunities, and companies that I really think have a chance for a triple-digit year, I would say one, gold companies. Gold is going to be the best performing asset class for 2022, in my opinion. This year reminds me already a lot of 2016, where the markets are tanking and gold is rising as a hedge. That means Wall Street is trying to protect and hedge all that they've made in the past 3 years, because the wealthy have done so well that they can take a year off. They don't need to take a lot of risk. There's no need, and that's the perfect environment for gold. Gold stocks are going to do extremely well, in my opinion. The easiest way to do it is through one of the indices or the ETFs or the baskets. Wealth Research Group, with our newsletter, we do profile companies that we see as attractive and that I personally invest in. On Monday, we profiled a company, for example, on Monday, 2 days ago, we profiled a company that's up 20% in the last 3 days. So there are big moves that are happening right now. But then I want to tell you about two amazing companies that are world-class that I'm going to invest in 2022 on weakness, okay, on weakness. So one company is called MSCI. It's a huge $50 billion company that is a financial company. It's similar to SPGI or to CBRE. These are giant financial companies, or to MKTX. These are companies that provide a lot of financial services. They have thick margins, and they're very sticky because they create indices. They're like a BlackRock. So I love that company. If you look at their long-term chart, they've been one of the best performing stocks in the world for the past 20 years. And on any weakness, I will keep accumulating them. They've been the best stock in my portfolio for the past 15 years. MSCI, that's one. And that's a financial, from the financial side. A company that I really love is Rollins, and that's a very boring company. It's an extermination company. They do exterminating of bugs and roaches and all that kind of stuff. Owned 55% by the Rollins family, and at these prices, between $30 and $33 a share, I'll be accumulating. If it drops below that, I'll be accumulating heavily. This stock for the past 15 years has been amazing for me, because I mean, one of the things that a lot of investors are starting to learn is that if companies have a growth spurt and it's over, and you want to take profits on that, there's a lot of taxes involved. So if you can get involved with companies that you never ever have to sell because they keep growing at decent rates and their prices don't get out of hand, so you can keep accumulating more shares at decent valuations. That's the Buffett formula. And if you look at, that's the magic. Buy companies that can grow for a very long time, for decades, at decent prices. That's the magic formula. So Rollins I like, and I also like CETAS, CTAS. Also look at these companies, look at their track record over the past 20, 30 years, and you'll understand why I get excited about them so much. And these are some of the first companies that I've noticed when I entered the markets like 20 years ago, because I've always been fascinated with these companies that grow, compound, and pay dividends.
Yeah, those are some pretty intriguing picks. I'm hoping people are enjoying what you're throwing out here, because you definitely come with a different perspective for sure. I'll throw out a couple things that I'm doing this year. I do agree with you that I think the larger tech companies are going to have a hard time growing because they've priced in the next 3 to 5 years at least. So they definitely need a good year of just earnings catch up and just, let's prove the PE ratios we're trading at. So I have a harder time buying the higher PE companies, even though I already own Microsoft. I just have a harder time buying it today. But I agree with you that Facebook would probably be my number one pick and is my number one buy probably over the last 6 months. From a PE evaluation standpoint, hasn't even touched the metaverse yet. I mean, and their primary business is still crushing it. And I expect it to continue to crush well, considering, again, these lockdowns and these kind of hold up periods. Well, we kind of experienced this kind of not as bad, pandemic situation. So I think that bodes well for the first quarter for them. And considering, I mean, Oculus was the number one downloaded app over Christmas, and we don't even know what that's going to look like yet from the balance sheet perspective in sales. But putting Facebook aside from the top 10, which would be that pick for me, I am agreeing with the Warren Buffett and the Charlie Munger side of investing. I've had a big eyeball on the Chinese company Alibaba, because against JD.com, Tencent, a lot of those large caps, it trades at the cheapest valuation. I have talked about this over the last couple of days. Actually, I'm just waiting for a confirmed turnaround. And if we can start seeing the numbers kind of begin to rise and we're getting less political rhetoric, now that we kind of understand what happens when these companies delist and things of that nature, I feel like there's a lot of upside potential, considering Charlie Munger just doubled down in the last quarter on that. I think he has 600,000 shares now in that position. I'm intrigued by it, but I'm approaching that with extreme caution, because I understand that there's it takes one political news cycle to come out again and that stock is back in the toilet. So there is a lot more risk that I think comes with that over Facebook, but the discount you're getting on that, I think, is absolutely nuts, presuming the numbers are truthful. But aside from that, I'm really intrigued by some of those dividend picks that you had for those long-term plays. I don't think people probably even know those companies exist. So I kind of love those underrated, smaller plays that are less probably news cycled. But on that note, I got some other things I got to get ready for here. But Leo, I really appreciate your time. These insights were great. Hopefully we can get this up later today. But thanks so much, man.
Thank you for having me.
Yeah, on that note, stay cool, stay awesome, anyone. And what are your stock picks? Let us know what you think about these in the comments section below, and consider subscribing, because we're going to get Leo probably back on. We usually try and get him on once a year here for these updates. So it's fun. Maybe we'll have to do a 1-year review when this stuff kind of plays out. But stay cool, stay awesome, and I look forward to catching you in the next one.